There is a particular kind of financial pain that rarely announces itself with a dramatic headline, because it does not arrive as one giant collapse, but as a series of small frictions that quietly multiply. A late payment here, an overdraft there, a rushed purchase, a bad loan term, a broken appliance handled on the wrong week, a balance carried 1 month longer than expected, and suddenly, the total cost of a relatively ordinary problem becomes strangely large. This is one of the least understood features of personal finance, because most people imagine expense in straight lines. A bill costs what it says it costs. A fee is just a fee. A delay is just a delay. But in real life, especially when money is tight or systems are fragile, small financial mistakes are rarely additive. They are compounding. They trigger second-order costs, timing costs, stress costs, and decision costs. The math behind them is not only numerical, it is structural. What makes small mistakes expensive is not simply that they happen, but where they happen inside a financial system. If a household has wide margins, liquid reserves, low fixed costs, and flexible timing, a minor error often remains minor. A late transfer might be mildly annoying. A forgotten subscription might be noticed and canceled. A repair might be paid and absorbed. But when a household is operating close to zero slack, the same mistake lands very differently. It falls into a system that has no room to contain it. That is when one small financial event starts pushing on other parts of the structure. A fee causes a lower balance. The lower balance creates another fee. The next bill hits earlier than expected. Credit is used to smooth the gap. Interest starts accruing. And what looked like a $20 problem becomes a $200 problem without ever feeling like one dramatic decision. This is why the real math of financial mistakes begins with fragility rather than arithmetic. A fragile system magnifies disturbances. In engineering, a tightly stressed structure can fail from relatively small pressure because it lacks shock absorption. In finance, the same principle appears in household cash flow. The narrower the margin between income and obligations, the more expensive a small error becomes. This means that the exact same mistake can carry radically different consequences for two different people. Forgetting a bill in a high buffer system may cost nothing more than a brief inconvenience. Forgetting a bill in a low buffer system may trigger fees, a missed auto payment, penalty interest, credit damage, emotional stress, and a rushed sequence of compensating decisions. The mistake is identical. The system is not. To see this clearly, consider the simplest example, a small late fee. On paper, it seems trivial. Perhaps the fee is $25. That number appears containable, even forgettable. But the late fee is often only the first visible cost. If the bill was paid late because the account balance was already tight, then that extra $25 reduces the money available for the next obligation. If the next obligation clears at the wrong moment, an overdraft can appear. If the person then shifts spending onto a credit card to keep essential purchases moving, interest enters the picture. If the payment history deteriorates, future borrowing may become slightly more expensive. If the missed payment happens in an emotionally strained week, the person may make additional rushed decisions simply to restore normality. The late fee was not the full cost. It was the trigger. That trigger effect is central to the mathematics of personal finance, because much of household life runs on sequencing. Money does not merely exist in totals. It exists in timed flows. Rent is due on one day. Payroll arrives on another. Utility bills are staggered. Subscriptions renew invisibly. Debt payments withdraw automatically. And irregular costs arrive with no regard for the calendar. In such an environment, timing errors are often more expensive than quantity errors. A person may technically have enough money for the month, and still incur multiple costs because money was not available in the right place at the right time. This is one reason small mistakes become so misleading. The amount itself looks manageable, but the sequence surrounding it is not. Behavioral economics helps explain why this happens so often. Under financial pressure, people do not think in clean spreadsheet logic. They prioritize immediacy, minimize discomfort, and try to preserve continuity. If an account is short, the instinct is often to solve the nearest problem first, not because the person lacks intelligence, but because urgent systems force local decision-making. A charge is covered with credit. A payment is delayed to protect cash for groceries. A repair is handled with the first available option rather than the cheapest one, because time pressure has its own cost. These choices often make perfect sense in the moment. The trouble is that each one can carry hidden future pricing. Convenience under pressure is usually more expensive than patience under stability. This is where the math becomes more subtle. A small financial mistake is not only the original error plus explicit fees. It also includes the premium charged by urgency. If a household has time, it can compare prices, wait for a better option, negotiate, batch purchases, or delay non-essential action. If a household lacks time because one mistake has already tightened the system, all those cheaper options begin to disappear. The person pays rush pricing, accepts worse financing, replaces instead of repairing, or chooses the closest solution rather than the best one. In effect, the original mistake buys the household less time, and less time raises prices. That increase rarely appears on a statement labeled as such, but it is real math all the same. There is also the issue of scale illusion. People tend to evaluate financial problems by face value rather than by percentage of available margin. A $30 fee sounds small in absolute terms, but if the remaining discretionary balance for the week was only $40, then the fee has effectively consumed most of the household's flexibility. Once flexibility is gone, further costs become more likely. This is why the same numeric mistake can feel emotionally insignificant to one person and operationally disastrous to another. The relevant number is not the fee itself. It is the fee relative to the spare capacity of the system. Margin, not income alone, determines whether a mistake stays local or spreads. Credit makes this even more important, because credit is often used to convert immediate disruption into deferred friction. At first, this can feel like relief. The appliance is replaced, the bill is paid, the car is repaired, and life keeps moving. But unless the balance is cleared quickly and cheaply, the original mistake now develops a time dimension. Interest is what happens when a past problem continues charging rent in the present. A seemingly small shortfall can become expensive not because the initial amount was huge, but because the repayment structure turns time into additional cost. The math here is often underestimated because the user focuses on minimum payments rather than total cost of carry. Minimum payments reduce short-term pressure while extending long-term drag. A similar dynamic appears in bank fees, penalty APRs, late charges, and short-term borrowing. These products and penalties do not merely respond to mistakes. They are designed to monetize fragility. The more a user needs immediate correction, the more expensive the correction becomes. This is not an accident of the system. It is often built into the system. When someone is forced to borrow at the exact moment they are weakest, the price of capital rises. When someone lacks the buffer to absorb a payment issue, the fee structure becomes harsher. In this sense, small mistakes become expensive, partly because modern financial systems are highly efficient at identifying and charging for low resilience. Historically, this pattern has existed in many forms. In older credit systems, the poor paid more through informal lending, merchant credit, and emergency borrowing because they lacked the bargaining power and reserves to wait. In industrial economies, workers who lived near subsistence margins often paid more for basics because they could not buy in bulk, travel for better prices, or withstand interruptions in employment. In modern consumer economies, the mechanism has become more digitized and less visible, but the pattern is recognizably similar. Small errors become expensive where time, cash, and flexibility are scarce, because scarcity itself creates premium pricing. One of the most overlooked costs in this process is decision degradation. Financial stress narrows cognition. Once a person enters a sequence of small problems, mental bandwidth is consumed by correction. More attention goes into tracking balances, avoiding penalties, moving due dates, juggling payment priorities, and protecting the next few days. This leaves less room for strategic thinking. That loss of clarity often produces additional mistakes, not because the person is careless, but because fatigue itself increases error rates. In that sense, small financial mistakes can become expensive partly by making future mistakes more likely. One weak decision environment leads to another. The math is recursive. There is a strong parallel here with health. A person who is sleep-deprived, overworked, and nutritionally unstable is more vulnerable to illness and, once ill, less able to recover quickly. A financially stressed household functions similarly. It is more exposed to routine setbacks and, once hit, less capable of stabilizing cheaply. The first mistake is rarely fatal. The expensive part is the compromised condition in which it lands. This is why financial resilience matters so much more than appearances. The visible lifestyle may say very little about the underlying ability to absorb ordinary human error. The lesson is not that people must become perfect. In fact, the opposite is closer to the truth. Personal financial systems should be built on the assumption that people will forget things, mistime things, underestimate things, and face occasional bad luck. A system that only works when executed flawlessly is not a robust system. It is a brittle one. The hidden math of expensive mistakes is really the math of brittleness. Every household is going to make small errors over time. The key question is whether those errors terminate quickly or cascade through the structure. This is why emergency funds matter in a deeper way than the usual advice suggests. They do not simply pay for surprises. They interrupt cost chains. They stop a repair from turning into debt, a debt balance from turning into interest, an interest charge from distorting next month's cash flow, and next month's distortion from forcing more expensive decisions. In other words, reserves reduce not just the first-order cost of a problem, but the multiplier effect attached to it. That multiplier effect is where much of the real damage happens. The same is true of lower fixed costs. A household with lighter monthly obligations has more room to absorb ordinary mistakes without translating them into systemic stress. A forgotten charge is easier to correct. A mistimed payment is less likely to trigger a cascade. Time pressure decreases. Options remain open. The household can recover using patience instead of urgency, and patience is usually cheaper. This is one reason that two people with identical incomes can experience very different financial realities. The person with more margin has not eliminated mistakes. They have reduced the price of making them. There is also a practical identity shift hidden in this topic. Many people think of financial competence as the ability to optimize every detail and avoid every error. A more mature understanding is that competence means designing a system in which inevitable errors remain affordable. That is a different mindset. It replaces perfection with containment. It values buffers over bravado, simplicity over tight optimization, and resilience over visible advancement. This is less exciting than the fantasy of total control, but it is much closer to how real stability works. Once you see the math this way, many ordinary behaviors look different. Buying slightly more time before due dates is financially valuable. Keeping a small reserve in checking is not laziness or idle cash, but friction reduction. Automating only the payments that a system can safely absorb is wiser than automating everything blindly. Maintaining lower utilization on credit is not just about score optimization, but about preserving recovery speed when something unexpected happens. Each of these choices lowers the multiplier attached to small mistakes. That is why the phrase "small mistakes" can be misleading. The mistake may be small, but the pricing environment around it often is not. Timing, margin, urgency, interest, penalties, and cognitive fatigue all act as multipliers. The real formula looks less like mistake plus fee and more like mistake times fragility. And because fragility is often hidden under routines that appear normal, many people do not recognize the pattern until they have paid for it repeatedly. In the end, the math behind why small financial mistakes become expensive is a lesson in systems, not morality. People are not ruined by tiny errors because the errors are enormous. They are hurt by tiny errors because their financial structure has no shock absorbers, and because modern cost systems are very good at charging extra when timing, resilience, and attention are weak. A stronger financial life does not eliminate mistakes. It lowers their amplification factor. It turns what would have become an expensive chain reaction back into what it should have been all along: a small, containable problem. That is the real goal. Not flawless execution, not constant vigilance, not living with such precision that no payment is ever late and no estimate is ever wrong, but building a structure where ordinary human imperfection does not cost a premium every time it shows up. Once that becomes the target, the mathematics of money starts to feel less punitive and more understandable. Small mistakes stop behaving like hidden traps because the system around them has finally been designed to let them stay small.